In this video, traders, we're going to look at monthly versus weekly options. Stay tuned. Hey traders and investors, a warm welcome to you. So you're probably aware of options, may not be aware of weekly options, or perhaps you are, but you're just looking to compare the differences between the two. If you are, we're going to look at this in this video and address some of the pros and cons of weekly options versus monthly options, what it's all about. So weekly options are pretty much as they say they are, weekly. They expire each Friday. So you get a new option on the Tuesday and then they expire on the Friday. So it's a very short-term focused event, very short-term focused window, should I say. In other words, you're trading for, I believe I want the right obligation to buy. If I'm buying a call option, that option at that price, that stock at that price at the end of Friday, basically. That's what you're saying. Or if I'm buying a put option, I want the obligation to sell that stock at that price on Friday. That's it. And so the window that you're looking at is very, very short compared to the monthly options, which can be way longer. It's not necessarily a month as such. It's a case of they expire on the month and you can buy them way further ahead. So you can buy them quarter, a year, all that kind of stuff. Whereas weeklies, they start, they expire, they start, they expire. So the idea of this is to take advantage of short-term trading opportunities. So if you're a short-term trader and you believe that you have an opportunity or a strategy involving the options, then weeklies may well be your thing. Anyway, let's have a look at some of the pros and cons. So first of all, the monthly options expire on the third Friday of the month, and weeklies expire every Friday. Now, one thing to note, guys, before we kind of push on, is if a stock is optionable, and you can look at that on FinViz or any of the screening programs, or a screening software, should I say, websites, if it's marked as optionable, there's always a monthly option, but there's not always a weekly option. Weeklies are reserved for some of the bigger stuff. And there's loads of stuff that's weekly options, all of them are the bigger stocks, the liquid stocks, the indices, the big ETFs. You know, there's massive amounts of there, but the smaller, less liquid stocks that are still optionable on the monthlies may not have the ability to trade weekly. So you don't get everything there. So that brings me quite nicely to these pros and cons. And one of the negatives with the weekly options is the liquidity. Unless you're on the big ones like Apple, SPY, Tesla, you know, all these kind of big boy stuff, stocks and ETFs, the liquidity can be low. So you've got to watch out for that. So just be careful of that one. But anyway, let's go in order, shall we? Weekly, the positives of weekly. So you've got regular opportunity because you've got fresh options being created every week. And you've got just fresh opportunity. So if you believe something's going to happen over the week, you can wait until that option fires off and we're away. And then you know that there's constant opportunity. They're repriced. There's brand new events happening. So you're always getting something with an expiry at the end of the week, which if you've got a plan that relies on that expiry happening, you've always got that occurring. And number two, useful for a short-term thesis. So just like I alluded to earlier, let's say you are buying a breakout. Let's say you think the stock is going to break out and you think then it's going to cause extreme volatility and it's going to kind of shoot off to the upside. And you're doing that on a technical pattern. You're looking at technicals and you say, yeah, okay, coming up to Tuesday perhaps, or late Tuesday or early Wednesday, it's pushing up. You might say, well, actually, if I buy a call option out of the money a little bit higher at my breakout target, it's not going to cost me so much because at the moment the pricing indicates that it's not expected to happen because volatility is low. But I know that if we break that level, I think we'll have a lot of volatility coming into the market, a lot of buying coming in. And if it works, not only will volatility increase, but I think we'll hit that strike price way quicker than people expect. I think the price difference or the rate of change, if you like, will be far bigger. And the weeklies can't account for that. Weeklies don't guess that thing. It's just an agreed implied volatility with all the other things that go into options pricing. So there's no kind of guessing that if it technically breaks out of that, then we're going to get more volatility. Then we'll take into account things like earnings, we'll talk about in a second. But if you technically believe you're going to get that, then an option might be the perfect thing for you. You might be able to risk a very small amount and you might see a many multiple gain if we start rolling and we start pushing up to the strike price and the volatility increases. All of a sudden that weekly option price is going to be very, very valuable. One thing to be careful of, and I may as well add it now while we're on the same topic, is that they can have big price swings. So yes, you can have that, but the decay can be brutal too. So what I mean by that, just say there is a pricing structure with options where you have the premium and you have intrinsic value, and the premium is basically zero at expiry, but that's the thing that gives you the extra bonus and extra juice before expiry. So longer to expiry, more premium, more volatility, more premium, or shall I say more implied volatility, more premium. So weekly, if you've got a sudden burst of volatility, you're going to get a big increase in premium and a big increase in the option value. But then if volatility starts to calm down, not only does time ticking literally because it's a weekly option, volatility compresses, that price of that weekly option will plummet through the floor. Now, you could look at that as a negative because you're in the money massively and you've got to be very quick because ultimately the decay is going to hit you. Or you could look at it as a positive. If you're a seller of options and you see a spike in volatility on a weekly basis that you don't think is sustainable, you could sell that option and take advantage of that decay, the time decay and the constriction of volatility, which would bring the premium down to effectively being zero. The premium will always be zero when it expires, it'll just be intrinsic value, but assume the option expires out of the money, that premium will go to zero and it might contract very, very quickly and you can trade an opportunity around that. So something to watch out for. Big price swings might be a positive or negative for you. Useful for a short-term thesis, like I say, regular opportunity, good for binary events, as are monthlies, but weeklies, because they're every week, you can say, hey, there's an earnings there. And if I literally just want to trade the earnings, weekly might be perfect for me because earnings could be on Wednesday evening or whatever. I trade over that Wednesday evening my position, whether it's an iron condor or a butterfly, whatever it may be, and I'm rather right or wrong. And all of a sudden that option is going to be worth almost the value that it should be. It's not going to have multiple weeks to go until expiry, which is still going to be priced into it. So I'm selling volatility over earnings and I've got some kind of strangle on or straddle, and it works, then the option is just going to go straight down to almost worthless if it's an out of the money options. That could be advantageous for me. Big price swings talks about. It can encourage over trading. Obviously, discipline issue here. If you feel like you're over trading, the opportunities always seem to be there. This may well encourage you to over trade and spend more on commissions and spreads and just generally the nemesis of a short-term trader. Liquidity, we talked about that one. Okay, monthly positives are you can have a long-term view with monthly options. So if you've got multiple month view, you can take that view with options, and which you can't do obviously weeklies. Way more liquidity. I say way more. Generally the liquidity goes in there because this is what the larger funds will be trading and this is where most of the money will be going. A less opportunity only because of the frequency of new options being created, and potentially less volatility just because the time to expiry, obviously the monthly will have a week at some point, and so they'll still have the volatility of the weekly option at some point, only once a month. But you just means that generally the volatility is dampened because it's further away and you won't get those extreme moves where the option prices are going to be in the money, out the money, premium high, premium low, much more sensitive to movement. So those are monthlies versus weekly options. If you're just starting out on options, probably monthly is the way to go. If you think that then you've got a handle on something, you think there's an opportunity or there's a strategy that you want to employ in a little bit more of a short time frame, maybe start to introduce the weeklies just to see how they trade and maybe chart them as well. Compare your monthlies to your weeklies to your actual underlying stock price and see how they move relative to the stock price, whether it's breaking resistance, when it's breaking support, when it's in a range, all that kind of stuff, and seeing how the three different charts interact and then bolting your strategy into the very best vehicle for you. Okay guys, monthlies versus weeklies. See you next one. Bye bye.